Public market equivalence. Is it apples and apples or apples and oranges? The way a public market equivalent analysis works in private equity is that I compare my private equity investment. So I invest, say, $1 on day zero and I sell my investment for $2 after 3 years. And I compare that with an equivalent quoted share. So I check out the share price on the same day I make my investment in private equity, and I look at the share price when I exit my investment and see how one has done relative to the other. And that, at the most basic, is the way PME is working. So one of the issues we have in PME is we have to choose a stock market index against which we're going to be benchmarking our private equity portfolio. And so one of the first issues is going to be, should I choose an index which represents large companies, or should I choose an index which represents small or mid-cap companies? The way we could answer the question of whether we should choose an index of large cap companies or small cap companies is to think about the relative risk of private equity investments compared to, say, a main index. So if I'm making private equity investments, I'm basically taking two sets of risks. The first set of risks is to do with illiquidity. My private equity portfolio is not liquid like quoted shares. And the second set of risks is to do with the type of companies I might invest in. If I'm, for example, a venture investor or growth investor, I'm going to be investing in companies which are slightly lower quality than large companies because they have lower governance, weaker market share, and various other issues. So that's a second set of risks, which I'm going to be having to account for when I compare my private equity portfolio to a benchmark of an index. So if I'm going to be comparing, for example, a portfolio of growth or early stage companies to a major stock market index of large companies, I have to include a premium which is going to take into account firstly the illiquidity risk and secondly the risk of the type of companies that I invest in. So two sets of risks. However, if I'm going to use as my benchmark a stock market index of small or mid-cap companies, the second type of risks is going to be double counted if I'm not careful. So in other words, if I'm going to be using an index, a stock market index of mid-cap companies, the only extra risk that I have in private equity is the illiquidity risk. Therefore, in practice, if I'm going to be benchmarking, say, my growth portfolio in private equity against a big index like the S&P, maybe I have to have a 500 basis points premium. But if I'm going to be benchmarking my portfolio against something like the Russell index of mid-cap stocks, I might have a premium of only 200 basis points. And that way I avoid double counting some of the risks that may be present in my portfolio. And that's something to be very aware of when you're deciding whether to use an index of large cap or mid-cap companies.